So everybody's talking about, I'll wait until rates drop, or I'll wait until property values come down. I found a pretty good article that articulates what took place as of 2020 up to this point as to why you shouldn't be holding your breath for rates to come down. Because the 2% rate is long gone. So let's dive into this quick article. The title of the article is You Won't Get a 2% Mortgage Again. How to Adjust to the Different Housing Market. The article reads, only a major economic crisis would cause mortgage rates to drop to those levels again. And it goes on to say, were the good old days really that good? Sure, when mortgage rates were below 3% and it was a lot cheaper to purchase a house. But we were also in the middle of a global pandemic. At the start of 2021, the average rate for a 30-year mortgage was 2.65, according to Freddie Mac. During the home buying boom of 2020 and 2021, the number of borrowers taking out a new mortgage reached more than 2-decade high. Over the past 2 years, a combination of high mortgage rates, low housing inventory, and a sluggish wage growth has crippled the affordability for homebuyers. While many are holding out for mortgage rates to fall, it's unlikely we'll see 2% rates anytime soon. In fact, experts hope we don't. A return to the kind of low-rate environment would indicate a major problem in the economy, said Alex Thomas, senior research analyst at John Burns Research and Consulting. Mortgage rates typically fall during a recession, but a recession also comes with widespread unemployment, increased debt, investment losses, and overall financial instability. In today's housing market, buyers should have realistic expectations. Experts predict mortgage rates to inch closer to 6% by the end of the year as inflation cools and the Federal Reserve starts to cut interest rates. Record low mortgage rates aren't in the cards again, and that's likely for the best. Now, this goes on to say something that I tell my borrowers every single day, which is mortgage rates change daily. Experts recommend shopping around to make sure you're getting the lowest rate. So what they're doing here, guys, is basically a lead generation source because they are disclosing the actual rate and points paid for this. You have to check the rate assumptions. In addition, most home buyers have no clue that you can't actually lock in your rate until you're under contract. So shopping around for mortgage rates prior to you having an actual contract and a property secured is just spinning your wheels. Now, it's a good question to ask yourself, how the heck did rates get below 3% in the first place? So this article goes on to say, how did mortgage rates drop below 3% in the first place? And this is important for anyone to understand. Simple supply and demand in addition to the pandemic. So let's read. Economic uncertainty and market volatility, whether during an election cycle or pandemic, impact the direction of mortgage rates. It's often said that bad news for the economy is good news for mortgage rates, and vice versa. A significant lever for mortgage rates is the federal funds rate, which the Fed keeps low when it needs to stimulate the economy's growth. For example, during 2008 financial crisis, the Fed slashed that benchmark rate to 0 to bolster the economy. When there were signs of recovery in 2015, the central bank started raising interest rates again, sending rates into the 4 to 5% range until 2020. The COVID-19 pandemic sparked another economic crisis. To incentivize people borrowing and spending money and avoiding a prolonged recession, the Fed once again cut the federal rate down to 0 and pumped money into the economy by purchasing government bonds and mortgage-backed securities. Mortgage interest rates fell quickly, bottoming out in the mid 2% range in 2021. But the combination of supply shock, record low rates, and extreme increase in money supply for government stimulus helped send prices way up, according to Aaron Skies, chief economist at Nest Seeker International. In early 2022, the Fed had new problems on their hands. Inflation. You're probably asking yourself, well, why did rates surge? Well, let's read on. With price surging in 2022, the Fed's main tool was to adjust the interest rate, making credit more expensive and decentivizing borrowers. As a result of a string of aggressive rate hikes, the Federal Reserve rate went from near zero to a range of 5.25% to 5.5%, where it remained since the summer. Average mortgage rates skyrocketed, peaking 8% last October. Although inflation has gone down, the Fed isn't ready to start lowering rates just yet. The central bank would like to see evidence that a weaker economy, including consistently lower inflation and higher unemployment, before making any adjustments to the monetary policy. Well, you may be scratching your head wondering, well, why can't rates just come back down to the twos again? Let's find out. Economists and housing market experts agree that mortgage rates will fall over the next several years, but not below 3%. When mortgage rates hit their record lows just a few years ago, the federal funds rate was near zero. As the Fed started cutting rates later this year, the plan is to do it slowly and incrementally. Bearing any major economic shock, the Fed projects the federal funds rate will take only modest adjustments down. The most recent policy meeting, Fed Chair Jerome Powell remarked that the federal funds rate will not go back down to the very low levels that we saw during the financial crisis, suggesting that the economy can adapt to more natural benchmark rates ranging between 2.4% and 3.8%. In the long run, less tightening but not too much easing from the current range of 5.25% to 5.5%. The Fed would be forced to lower rates closer to zero only if there was a dramatic economic shock, such as a pandemic or a recession, said Selma Heap, chief economist at CoreLogic. In that case, if the central bank started purchasing government bonds and mortgage-backed securities again, there's a possibility that mortgage rates could return to the record lows. However, with the Federal Reserve ending quantitative easing and stepping out of the market mortgage-backed securities, rates will settle at a much higher level, said Matthew Welsh, housing economist at Moody Analytics. Moody Analytics predicts mortgage rates will stabilize between 6 and 6.5% over the next few years. That's high compared to with the recent past, but it's historically a normal range for mortgage rates. Now, onto the last piece of what you're probably wondering is how can buyers adapt to these new mortgage rates? Let's find out. The housing market is frustrating, but prospective homebuyers are starting to come to terms with the new reality following the pandemic, and people are moving on with their lives, whether that's building a family, relocating, downsizing, or upgrading. For some households, that means making room in their budget for the monthly mortgage payment at the 6 or 7% rate. When you monitor mortgage rate movement, you're usually looking at the national average determined by a weekly information provided by lenders. While those rates give a picture of the typical mortgage rate, it's not necessarily the rate that you've got or will get when you apply for a mortgage. It's possible to get better on your mortgage. To qualify for a mortgage, most lenders will require you to have a minimum credit score of 620. I'd also like to add that some lenders, like myself, offer loans down to 580 with 3.5% down. Not all will qualify, but we do offer. But lenders offer lower mortgage rates to consumers with excellent credit, around 740 and above. You may also consider purchasing mortgage points, also known as discount points. This is an extra fee you pay up front in exchange for a lower interest rate. Each mortgage point typically costs 1% of the purchase price of the home and will lower the mortgage rate by about 0.25%. A shorter term loan, 15 or 10 years, will have a lower interest rate than a 30-year fixed mortgage. Your monthly payment will be higher with a shorter term because you're paying the loan off in less time, but you'll save big on interest. Buying a home is likely the biggest transaction that you're ever going to make in your lifetime. Regardless of the market, carefully assess your needs and what you can afford, and don't hold your breath for those 2% rates. I'm Mark Jones, President and Senior Loan Officer, and iThink Mortgage.